Rahul Goswami is Chief Investment Officer and Managing Director, Fixed Income India at Franklin Templeton Asset Management India. He brings over 24 years of experience in managing fixed income funds, and Franklin Templeton is a homecoming of sorts. You'll find out just why in a minute. Welcome, Rahul. Welcome.
Thank you, Vansi. Thanks a lot.
And good to have you here. And I said, this is a homecoming for Rahul because between 2002 and 2004...
Yeah, 2002 to 2004, I was part of Franklin Templeton in fixed income.
Rahul was part of Franklin Templeton Fixed Income between 2002 2004. So I can say that coming back here after what is quite a sizable gap.
Yeah, it's about, say, 19 years gap. So
yeah, so that's quite a big parivartan. What is it
correct.
Sort of felt like coming back here?
I think the energy is new and it's all fully energized, and I think we are looking at a much more, brighter future as far as fixed income from Franklin Stable is concerned.
Okay, so you're energized, and we're going to explore what the source of that energy is for you. I feel like I asked Avi this question last year, and now you're in the hot seat. I'm asking you this question. What priorities have you set for the first 100 days?
So it's not about 100 days or 50 days for that matter.
I'm from the news business. I have to make it sound all exciting. Priorities for the first 100 days.
See, it's all about, so my first priority or topmost priority for the Franklin Templeton India and the global team is that as far as Franklin Fixed Income India is concerned, I think we have to solidify the investment capabilities. That includes further strengthening on the knowledge and skill set on the desk, plus strengthening the processes and discipline and controls. So I think that's what we look at, so that apart from that, the key focus will be over a period of time to expand the product suite that we are able to offer to the investors and to help them, achieve their financial objectives.
Okay, I think those are very important aspects that you referred to. I was sounding a bit flippant in the beginning, so I apologize for that. But really strengthening the practices, strengthening the approach that the fixed income team applies, which brings me to, some of your assessments here and now. The RBI began its rate hike cycle in May 2022, 40 basis point hike. Since then, the repo rate has been raised sequentially to 6.5%. Markets want to believe that interest rates or policy interest rates are going to fall soon. But you have to acknowledge that global fixed income markets are still not out of the woods. So I'm basically asking you, what is your take on future interest rates?
So I think the Reserve Bank of India and Government of India did a fantastic job as far as the COVID times monetary and fiscal steps are concerned. We did not push very, very highly or pushed very much, at least on the fiscal expansion side, against our Western counterparts or say developed nations' economies concerned. So India did not, engage in too much of fiscal expansion, and they effectively controlled the damage on the COVID front and the economic recovery side. So RBI during 2020, 21, 22, those two and a half years was very, very supportive of the growth and the recovery in the Indian economy, which was warranted at that point of time. But post that, in line with other central banks and RBI first raised 40 basis points in May of 2022 as far as the repo rate was concerned, repo rate is concerned. After that, they have raised rates by 250 basis points, but whereas if you see that US Fed has already raised rates from that period by 525 basis points. So the difference is actually what the DM world did or the developed economies did and how the various emerging market economies perform. And different economies responded on the COVID, had a very different response on the COVID situation. And that's what we have seen, that RBI had to raise rates only by 250 basis points, whereas other central banks had to raise rates much more. You take the case of Japan, they have not yet raised rates anywhere, but what they are doing is probably they are removing controls on the YCC on a gradual basis. So every economy works in a different manner, and India, I think administration has done a fantastic job as far as handling the inflation and the growth dynamics during and post-COVID in a much better way.
So we've sort of taken stock of some of the actions of the government and of the central bank, the approach, etc. But sitting here in September 2023, where do you think policy rates in India are headed?
So our base case scenario is that inflation will probably remain for next, say, 3 to 5 years. I think average inflation will be 5.5 centric or so. And unless we have a very, very, surprising situation on the global front that can hit us on the negative side, on the growth or the investment or inflation. But outside of that, I think in line with global central banks, we think that there is high probability, I assign that India rates will remain in the range of slightly elevated than what we have seen around, say, 2018 to 2022.
So you think they're going to remain slightly elevated?
That's correct. I don't think that there is much scope in the near term, which is 2 to 4 quarters, for the Indian, bond yields or policy rates coming down from current levels. Some minute correction here and there is always possible, but outside of that, the probability I assign is pretty low.
Okay, interesting point, and I hope everyone in the audience is listening carefully, because I'm going to navigate all of the interconnected pieces here with you, Rahul. The difference between Indian and US inflation has typically been in the range of 4 to 5%. If US inflation stays higher for longer, how would Indian policymakers sort of absorb, adjust, react?
So how I see it is that the current account is of much bigger importance than inflation. Current account is a faster reflection of whether inflation is going to hit or no. Current account is effectively how much you are producing and how much you are consuming. So if you are deficit in that, then probably you'll have to substitute it with imports and manage that. And that typically gives much better pricing power to the manufacturer. Having said that, so if you see 2014 to 2020, those 6 years, average US inflation was about, say, 2 to 2.25% or 2 to 2.5%, whereas India retail inflation during that period was 4.75%. So though gone were the days when US inflation used to be 4 to 5% lower than India, or India inflation, in another way you can say that India inflation used to be 4 to 5% higher than US inflation. Last 5 years, we have seen, like, say, 2014 to 20, we have seen India inflation was roughly about, say, 275, roughly 300 basis points higher than US. And post 2020 to 23, we have seen 3.5 years that average in US inflation has been much higher than India inflation. So it is pretty, so situation has changed, and you have to give credit to the, administration for handling the situation. Plus the inflation dynamics in the recent past in the two countries have been very, very, different. US has seen much more of services inflation and not much of manufacturing inflation, if you see point to point 2020 to 23. So I think India inflation is unlikely to remain, say, more than 300, 350 basis points over US, but that itself is elevated because US has inflation target of 2%, we have inflation target of 4%. So I think India may not have required to raise the rates too much, but the scope of cutting rates is also pretty minimal.
Okay, so we've talked about US inflation versus Indian inflation rates. I want to zero in on what's happening as far as inflation in India is concerned. So, okay, the headline inflation is cooling off, but then when you look at food inflation, it's about 40% of the CPI basket. It has posed an upside risk. There seems to be no doubt about that. How does this restrict the RBI's ability to take perhaps a dovish stance?
So post 2018, we have seen RBI being much more supportive of growth against against the earlier regimes. But yeah, means if food inflation starts behaving, because food inflation was lower through 2014 to 2020.
Yeah.
And even 20 to 23 food inflation has not been lower. So that has typically, supported RBI, stance on raising rates in 22 and 23. But no central banks is going to raise rates or cut rates by looking at prices of tomato or potato or onion for that matter. But yeah, they will obviously be worried about it if the broader food cycle shows, much stronger trends of price increases. And that certainly will limit their ability to be, even more supportive of the economy by lowering rates or keeping the easy monetary policy stance.
So you're actually saying, and please correct me if I'm paraphrasing wrong, you're saying the central bank is not going to be overwhelmingly guided by food inflation, and it is going to take a stance supportive of growth. Have I paraphrased that correctly or missed something?
So I think RBI or the central banks logically see through part of the food inflation, but if the food inflation is becoming more and more broad based, then typically, or say more and more commodities show strong price increasing trends, then central banks starts typically panicking and reacting. The bigger problem is not just the inflation at some point of time or at any point of time, but it's more of inflation expectations that they have to manage.
Yeah, exactly. I'm crisscrossing here because I want to get your insights on a bunch of different things. And one of them is the fact that, okay, and this may sound like a naive thesis to you, but as global growth rates slow, demand for commodities comes down in major importing countries, and I'm thinking China here right now. And I say, oh, that's great for crude prices for India, and that's great for inflation in India. Now, that hypothesis that I've just presented to you, does it make sense? Does it play out?
It is not just the growth and consumption dynamics in the near term can play all the possible role. But what I believe is that apart from the growth and consumption cycle, or say growth and consumption situation, crude oil or other commodities have a lot more have seen impact from geopolitical situation. Though demand has seen, moderation against the earlier expectations about, say, 2 to 4 quarters back. But what we have seen is that the geopolitical and supply side also has been controlled by Saudi, and the supply from Russia has been curtailed to the some parts of the world, though some other countries have benefited out of that. But, there is supply side dynamics also that has to be kept in mind before.
Absolutely. Let's get down to business. And especially when I say let's get down to business, it's because everyone in this audience is looking to hear this from your mouth. Given what we've just discussed about the macro scenario, where in the yield curve does Rahul Goswami see pockets of opportunity?
Yeah, it's a very, very difficult question, and I can tell you it's not so easy. Like, say, India 1-year T-bill trading at close to 7.1%, and 10-year bond at 7.20, 30-year bond at, or rather 10-year bond at 7.12 as we speak, and 30-year bond at 7.30. So curve is reasonably flat. I would be more from controlling the risk point of view is concerned. I would be more inclined to be positioned at the shorter end of the curve rather than longer end of the curve. So I would like ideally to avoid duration risk at this point of time.
Okay, I want you to repeat that so that everybody sitting here really absorbs what you
I
just
think
said.
the shorter end of the curve from risk reward perspective is much better placed than the longer end of the curve. The curve is very, very flat. There is hardly any reward for somebody to run the duration risk. And so I would be advocating at this point of time either the high accrual products or the dynamic bond fund category, which will typically be able to move the duration in the respective funds as the market opportunity arises.
Okay, that's as direct and comprehensive as it gets. I'm changing gears completely out here, Rahul. And you've been investing, what, 24 years now?
Yeah, roughly
About 24 years?
Yeah.
What evolutions, what parivartan, what change have you seen in the fixed income market in India? And reflect a little bit on what you've learned also in this 24-year journey.
So I tend to agree with what Anand was saying. I think the process and controls and discipline are of utmost importance for me. And that's what I believe that has probably worked. As they say, there are old pilots, there are bold pilots, but there are no old and bold pilots. So it typically means that you have to stick to the process and the discipline and controls in the investment and not to, get carried away. And that typically helps you in reducing the probability of mistakes. And that itself can save you from many, many problems and challenges and underperformance in the fund.
Okay, well said. What about the changes that you've seen in the fixed income market over the last 24 years?
Last 3-4 years?
No, 24
Last
years.
24
I'm
years,
going
sorry.
all the way back to the
Okay.
beginning of your career to now.
No, I think the market is much more transparent now. There is the flow of information has improved tons and tons. And sometimes after these, recording regulations by the SEBI that have been put for fund managers, I think otherwise market is much better informed on the minute-to-minute developments in the investment teams at the fund houses. So, but yeah, information flow thanks to, various social media and all. I think there are different channels people run on that. So the flow of information has improved multiple times. And flow of information, flow of views, and flow of different perspectives has... So the time-wise, it has become much shorter time to react and to, everything gets priced in pretty efficiently in a much shorter period of time. So that's, I think, the speed of information has changed a lot. From 2000 to 2023, if you see, the regulators have improved a lot. Have improved means have improvised a lot as far as the regulations and the safety for a retail investor as far as mutual funds are concerned. That
has become center stage. I mean, it's like the central tenet that
I
sort of
think
guides
regulators
everything.
have done a great job as far as protecting, the normal persons invested in investments in banks and mutual funds. And so I think there's a lot of work that has happened on the regulatory side. From the mutual fund perspective, I think the classification of funds, clear categorization of funds, that has also helped a lot as far as and as Avi said that I think it's a matter of further improvement possibility in financial literacy that will induce or that will trigger much higher participation in mutual funds, be it the equity funds or the debt funds. Equity funds typically have a much better retail reach, whereas the institutional clients or the institutional investors or semi-wholesale or wholesale investors have preferred, because of their risk mandates and also have preferred more on the fixed income side. But I think it's a function of financial literacy that will drive the further expansion and deepening of mutual funds in the customer's wallet.
Okay. If you notice, I'm moving from reflective to, opportunities. And I'm literally alternating. I'm asking one opportunity-related question. I'm asking one reflective question. How do you think that debt fund investors should position themselves right now? And are there any sort of tactical allocations that you would recommend?
I believe that right now I would be more keen for, like I can suggest to our respected partners what I can suggest to my family, that I think the lower duration or relatively higher accrual or dynamic bond fund product are in a better situation to capture the potential opportunities that can emerge over a period of time. And I would clearly not of the view of increasing the duration risk in the portfolio as far as there will be time where we will come and request you to increase the duration risk and reduce the reinvestment risk over a period of time, but not at this point of time.
Okay. The general elections, early 2024, how should investors factor that into their positioning?
So I'm not too bothered about general elections, at least say on the fixed income side, because overall fundamentals, growth prospects look very, very promising and strong. And from the risk perspective, if you see, RBI has amassed reserves of about $625 billion if you adjust it for their forward positions. So I think macro-wise we are very much in a good situation as far as potential risks from elections are concerned. But elections we have seen 1999 or 2004 or 2009. Every time the elections may have given some nasty reactions by the market, but it has not played out very unfavorably for the investors to remain there.
So you're saying that even if there is an impact, at best it is a transient,
Could be short-lived.
short-lived, and
correct.
will sort of make its way
And
out.
I
in
believe
terms
as
of
long as the mandate is a clear mandate in the coming elections, there is no problem as per se on the.
Okay, a couple of other trends I want to talk to you about. Bank balance sheets, they've improved in terms of NPAs. Corporate balance sheets, they've deleveraged. So then, do you see this translating into credit upgrades, less downgrades?
Yeah, so after AQR, which was done in, say, asset quality revision that was done for banks in 2016 under Raghuram Rajan and after that, so 2015-16. So banks have much better balance sheet, and after 2020, a lot of capital raising was also done by banks, including many of the private sector banks. So I think, yes, what you're saying is correct, that bank balance sheets are in superb shape. And whatever limited fiscal expansion we had, and I think the corporate balance sheets have also been deleveraged after 2020. So yes, banks and private sector balance sheets are pretty good. Only the household balance sheets may not be as in the same situation, but it's not that they are bad. But yeah, I think that there is the potential. Till now, we have not seen excess investment cycle beginning to take shape. So we think that the upgrade to downgrade ratio is not likely to deteriorate next couple of years.
Okay, good to hear you address that squarely. And, you've alluded to it, but I'm going to sort of try and ask you to bring it all under one umbrella, throw some light, or articulate comprehensively your fixed income strategy going forward, and would there be any changes for existing funds?
So existing funds are suited well as far as catering to the different investor sets are concerned, but obviously we will look to expand as and when possible, subject to regulatory approvals and market opportunities. And it's a continuous process, and even 5 years down the line, 10 years down the line, we'll continue to do that. And that's what happens typically, that looking at opportunity and the suitability for long-term investment by potential investors, we'll look at the funds and the opportunity that can be taken up to take it to the market and to the respective channel partners.
So at the risk of forcing you to repeat yourself, articulate what your fixed income strategy is here and going forward. What are some of the tenets or the sort of supporting pillars for your fixed income strategy?
So yeah, thanks. So as I said that the effort right now is to overall improve the investment capability. That includes improving the further improvement on the knowledge and skill set, the process, the discipline and controls. That typically, and apart from the new fund launches that may happen over a period of time, that will be in a that's what I believe that we'll be in a position to cater to different investors and channel partners to suggest and advise their respective clients to basically participate in our funds to meet their financial objectives.
Okay. I'm asking this question to everyone, so you can't escape it either. Um, we've seen a lot of fintech companies launching bond investment platforms. You've got the RBI, the NSE have their own platforms. How do you view all of these developments?
So you are asking about these fintech companies offering bonds at demand.
Yeah.
I think that's a pretty risky strategy, and one should be very careful given the financial literacy levels in the country is concerned. I think participating through mutual funds is a much better strategy that gives you instant liquidity. You press the button and you have money in your account the very next day. So you have much better liquidity, much better diversification, much better credit quality. Obviously, it comes with a slightly lower return than potentially risky assets. But I think return of investment is equally important to return on investment. Just don't look at return on investment, also look at return of investments.
Okay. Very straight, punchy answer on that. If you had to sort of take a guess as to what is the RBI's key concern at the moment, is it foreign exchange reserves? Is it inflation? Or is it liquidity? What would your pick or guess be?
I don't think RBI in present scheme of things, as long as India is going through current account balance of negative balance of 1.1 to 1.5%, I don't think RBI will be bothered about currency levels. I firmly believe that looking at the growth and inflation dynamic is concerned, I think they'll be more bothered on liquidity and inflation rather than currency. So I think that's what RBI is trying to talk about, liquidity in the minutes also and in the latest monthly bulletin as well. So there I think RBI will keep taking steps on controlling liquidity and not letting liquidity, spread too much in the system so that it, creates a slightly elevated inflation situation over a period of time.
So liquidity and inflation, key concerns
Yeah.
of the RBI, top of the mind as far as RBI's preoccupations
Yeah, I
are
think
concerned.
Forex-wise, they are very well positioned. They have reserves in excess of $600 billion plus, and they have forward long positions, which gives them, comfort or cushion to tide over any challenges as far as the FX volatility is concerned. And then nobody can raid your country on the FX side as long as you have current account, which is only 1 and 1.5% deficit.
Okay. Now forgive me, but it seems like I'm doing a poll here. But take part in my poll, which is this question that I've put to everyone so far, which is artificial intelligence. I have to say, I get terrified by things like ChatGPT. If that's the only AI sort of example that I've been exposed to. But my question to you, Rahul, is this. Artificial intelligence, emerging technologies, how do you see them disrupting the asset management space per se?
As you rightly said at the beginning of the show that change before the change forces you to change. So I think there's the only way to, survive and, continuously evolve with, changing situation, and that's
So leverage it, leverage AI.
Yeah, you
harness
have to
it.
live with it, you have to leverage it rather than, sit out and not to accept it.
Okay. Completely changing focus now. And you're forewarned, I am not talking about fixed income strategy. I am not talking about RBI and what its preoccupations are. I'm not talking about Franklin Templeton. I'm talking or turning attention to Rahul Goswami, the person. Okay? Beyond work. And I think everyone here would be curious to know more about you professionally and personally, which is why I'm asking you. Beyond work, what sort of gets you energized, it sort of recharges you?
Okay, yeah. Yeah, so if I have free time, which is I normally have, weekends. So I am more a family guy, and I enjoy with my kids. Look forward to spend time with them. Plus, I have two, dog pets at my house. And otherwise, I, try to catch up with my family and friends over the weekends, and probably talk to them and go for long walks. That's what is my routine. And still, if I have time, then probably I try to watch tennis and
Watch tennis.
yeah, tennis and Formula One.
You have no time for movies and shows. I think I remember that from one of our
there's
conversations.
I don't have enough time to. No OTTs, no movies, no shows.
You know, what would your message be to this large gathering of partners of Franklin Templeton who are here today? What is Rahul Goswami's message?
I think investment is a long journey. It's not there's no quick gun, Murugan remedy for anything. And it's a long journey, and it's a long, consistent performances and processes that will give you the right return. And I think that you must participate with Templeton, and thank you everyone for participating with Templeton till now. And on the equity side, on the hybrid side, on the fixed income side, we look forward to your support.
Perfect. Thank you very much. Rahul Goswami, ladies and gentlemen.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.